Thanks for joining me and Mitchell here today, Mitchell of Blockware Solutions. How are you doing? Thank you for coming back on the channel. I've been excited to do this for a while, and yeah, you've got some great insights to share with us today, so I'm very excited for this one.
Yeah, thanks for having me, Matt. I enjoyed coming on the show a few months back. You put out great research, and you and we both discuss a lot of the same things. So I'm excited to have this conversation. At the time of recording, it is 8:45 p.m. Eastern time on October 1st. Bitcoin's been pumping all day long. The vibes are high, about to break 120K. So I'm excited to talk about everything going on in the market.
Amazing. Well, we'll jump straight into it. Recently, you launched the report, which I thought was great. Very interesting, covered a lot of amazing data points. I will say a few bits that I maybe don't 100% agree with, but I think we can get into that. I think that'll help to kind of have that debate and back and forth. But it's discussing the potential end of the Bitcoin 4-year cycle. So we'll just go straight into it. If you can give us a brief introduction into kind of this thesis and basis and data behind this kind of mindset that you've gone towards.
Yeah, and feel free to tear this apart left and right at any point because I've been dying to have someone like prove me wrong here on this. So the high level is I think the 4-year cycles are over. And this report unpacks a plethora of reasons why I believe that. And the main point is the structural shift before and after the ETFs. So you can see that simply when you look at Bitcoin price action after the ETF, we haven't had a drawdown of more than 30%. We have not had these explosive moves. Every time Bitcoin goes up 50 to 100%, you see on-chain long-term holders rebalancing coins. And, we can, I think a good place to start is to kind of rewind and think about catalysts for the previous quote unquote cycles. Because the idea behind the 4-year cycle is that Bitcoin's halvings every 4 years, 2012, 16, 20, 24, causes a structural shift in the supply and demand that causes a massive blow off top, and it's followed by a devastating bear market. Now, I think you can make that case pretty strongly for 2012 and 2017. Bitcoin had such a low market cap, not, not the overwhelming majority of coins were in circulation at that point. So, a kind of marginal change in the supply issuance back then, I think could have a very noticeable impact on Bitcoin's price. But in 2021, everything went up. This wasn't some Bitcoin specific bull market. We had a record amount of money printing in 2020. Every tech stock, every meme coin, every NFT, everything in the entire world went up explosively in 2021. And then the Fed slammed on their brakes starting at, they started signaling that towards the end of Q4 2021. They actually started hiking rates in 2022, got a massive bear market and everything, tech stocks, the NASDAQ, S&P, Bitcoin, et cetera, et cetera. So I think historically our perception of cycles may be distorted a little bit, thinking that, it's these halvings every 4 years that cause that. And so coming back to the present day, since the ETFs, we have this huge structural shift. You have a change in price action. You have volatility in general is just a lot lower. So if we look at a chart of Bitcoin's realized volatility, I've got the ETF here, and this red line marks the start of the ETF. Post ETF versus pre ETF, far less volatile. When we go into some of the on-chain data, you can see here the net unrealized profit loss. So I'll pause here. One thing that the ETF really did, I'm pretty convicted of this, or convinced rather, is it brought in a new type of market participant, the institutional investor. Everyone knows that pretty much. It's a given, right? But you have to think about how this investor actually behaves. They're not the retail degenerate that, for lack of a better word, that existed before the ETF in the Bitcoin world, right? Who's looking for these 10x's, these massive returns, and who also has the cojones to endure a massive bear market. The institutional investor comes from the world of stocks and bonds, where they're looking for, 10 to 15% every year, 15% return. That's a good year for them. So when you put them into the Bitcoin world, they're going to be a lot quicker to realize profits and losses. And you can see that on chain. So on the net unrealized profit loss, it's just kind of oscillated in this very tight range since the ETFs were created. On a market cap adjusted basis, realized profits haven't really exceeded major levels like they did in previous Bitcoin bull markets. And it's quite simple. An investor who couldn't buy Bitcoin before the ETF, either because they legally can't deal with the custodial challenge of buying their own coins, or, they simply are looking for a lower friction way to just buy Bitcoin in their brokerage account. That type of investor who didn't exist before the ETFs were created, they're going to take profits. They've been holding Bitcoin for 6 months. They got a 50% return. They're going to sell into that. And the on-chain data shows that. I'll pause there before I keep going. Do you have anything you disagree with or anything threads you want to pull on?
No, no, I think it's so far we're both kind of aligned in how the market is shifting, and of course, Bitcoin is an evolution of money. But no, so far I think we're pretty much in agreement.
Awesome. So with that, the groundwork and the kind of present day analyze, I think where we're shifting now is instead of these having potentially being a impact of supply and demand and affecting the price, I think it's going to be far more driven by a couple of different things. So on the supply side, it's going to be hodler behavior, and we kind of get in that later in the report. But on the demand side, it's purely, I think, a matter of capital inflows, which can come from two different sources. One, you can have more ETF-like instruments that enable capital to flow into the network with less friction. So the primary example would be Bitcoin Treasury companies or the preferred stock of some of these Bitcoin Treasury companies, just creating more connections from the fiat capital pools to the Bitcoin world. You're going to see more capital inflows into Bitcoin. And second would be increasing fiat liquidity. And we can kind of unpack the macro stuff later. But realized cap, as you know, Matt, it's kind of the best way to see capital inflows because it's the on-chain footprint of Bitcoin's moving at a certain price. And we can know, pretty much to a very certain degree that, when realized cap is over $1 trillion of capital has been input into the Bitcoin network. And when we look at the ratio between the market cap and the realized cap, post ETF, it's just oscillated between 1.5 and 2.5. And what I did in this report is I ran a couple statistical regressions looking at the impact of realized cap onto market cap. So how much do capital inflows actually impact the Bitcoin price? What's kind of the response from the market to new capital inflows? And before the ETF, it was very volatile. It was, directionally correlated. You can see this slope here is pretty much up and to the right. Over the long term, more capital coming into the network resulted in the market cap going up. That makes sense. But there was a huge variance in sort of the immediate response. And so after the ETF, it's become far more steady, where new capital inflows equals price go up. And again, when you look at the MVRV ratio, you can see that drastic decrease in volatility from the market in terms of how it reacts to capital inflows. Historically, you would get these massive multipliers. New capital comes in, the Bitcoin price would put a multiple of 5 to 10x on that. Now it's a lot more steady between 1.5 to 2.5x. And there's another chart here that kind of shows the spread of the residuals. So if you take realized cap as kind of your independent variable, and then market cap is your dependent variable, we're trying to predict the price based on capital inflows. You can see this box and whiskers chart on the left shows the response had a huge variance between what we would expect the price to be based on new capital inflows and what it actually was. Massive spread versus a much tighter spread post ETF. This bar chart here shows the same thing. So what's the range of predicted price values based on capital inflows? The range is a lot wider post ETF. So it's basically in response to capital inflows now. So with that in kind of in our minds, we can, you can almost extrapolate out what capital inflows are going to be because they've been very consistent after the ETF. And I get into that later in the report. This section here kind of touches on what I mentioned at the top of the video, which is the diminishing marginal impact of each halving. So in 2012, the cut in supply or Bitcoin's inflation rate relative to the amount of Bitcoin already in circulation, pretty big, pretty significant impact there. But it's just continuing to diminish over time. And so we can't necessarily, in my opinion, expect these 4-year cycles to revolve around the halvings rather than looking at some of the other indicators. Again, you can see here, as I mentioned before, I think the new supply side factor to look out for is holder behavior, specifically long-term holder behavior, because they control the majority of all the Bitcoin out there. And we basically treaded sideways at 100,000 for the last like 10 months, more or less. We went down to 80, up to 120, but we've been in this range around 100,000. And to me, that makes total sense. And it's actually very bullish because we have, who knows, God knows how many Bitcoiners that bought Bitcoin way back when and are like, I'm selling at 100,000. I'm upgrading my life. I'm buying a house, buying a Lambo, buying all these things. And we've seen an immense amount of selling at these levels, right? You can see huge drawdowns in long-term holder supply every time the Bitcoin price goes up 25 to 50%. But what's bullish is that there's actually been enough demand to absorb all of the sell pressure. We're talking billions and billions of dollars of sell pressure into Bitcoin over the last 12 months. And Bitcoin's pretty much, held very, very strong. You have hundreds of thousands of coins moving from long-term holders, but the Bitcoin price has still managed to hang around this $100,000 range. And so for me, I'm not looking at halvings anymore. I'm just watching holder behavior to kind of gauge the supply side of the equation. And for the demand side, like I said, it's capital inflows. There's things that impact that, but primarily I'm looking at realized cap to gauge that. And then another thing I think that's important to consider is decreasing volatility has happened with other digital monopolies. So Bitcoin's its own unique asset class. There is no one-to-one comparison you can make, but it does trade pretty similar to other tech stocks. And fundamentally, it's a digital monopoly. The world doesn't quite fully understand the scope of its impact, just like it didn't understand the impact of Amazon and Apple and Microsoft during the early days of those equities. And so what we saw with those equities, if you look here, this black line kind of takes the aggregate of some of these major tech monopolies. So Apple, Amazon, Google, Facebook, and Microsoft. Incredible volatility during the first 10 to 20 years, but the volatility goes down over time as it becomes a bigger asset class. And as the actual value proposition and use case of the technology becomes more clear, and as adoption increases of the underlying technology, I think Bitcoin's the same way. Obviously, much more volatile relatively, but we can see that volatility is diminished, and I think it will continue to diminish over time. Same with its drawdowns. So early on, all of these tech stocks they would have massive drawdowns. Amazon's notorious for having like 90% drawdowns or something crazy. And I think it's Michael Saylor that says Jeff Bezos didn't become rich trading Amazon stock. He became rich holding Amazon stock for a really, really long period of time. And so I think Bitcoin's much, much the same. But I will emphasize, I don't think Bitcoin is not going to be volatile anymore, especially relative to stocks and bonds. Going to be super volatile, just not volatile relative to Bitcoin's past performance. And then I close out the report with this three-dimensional chart that I really enjoy, which has realized cap on one axis. You've got the MVRV multiple on the other, and then on the Z-axis, it extrapolates to a Bitcoin price. So you can basically pick a number out of a hat, more or less. I think Bitcoin's going to absorb $2 trillion of capital over the next 4 or 5 years. So you take the current realized cap is 1 trillion, add another 2 to that, you get to 3 trillion. Based on the range of market cap multiples over the last 18 months since the ETF was created, you'd be looking at a Bitcoin price of around $300,000. And I think that's pretty bearish. I think, there's a lot of things that could accelerate how much capital goes into the Bitcoin network. What I've done in this chart is I've just extrapolated the last 12 months growth in realized cap, which is about $400 billion over the next 4 years. And that gets you to this, $2.7 trillion realized cap. You can throw a couple multiples on that and you get a Bitcoin price anywhere from, what does it say? 250,000 to 320,000. Again, I think that's very bearish, because Bitcoin could absorb a lot more capital than that over the coming years as we get more Bitcoin treasury companies, and especially as we just get more fiat liquidity in the system. We're kind of reaching a very critical point, I believe, with the debt at $37 trillion. Interest rates, still they're going to come down, but the actual blended average of what the United States government pays on their outstanding debt is going up because a lot of the debt refinanced at ZERP levels is now being refinanced at the higher rates. And so I think we're just going to continue to see them monetize the debt by printing currency. And that currency is going to find its way into Bitcoin through a variety of these, ETFs, Bitcoin treasury companies, etc. So I'll stop the screen share there and Tell me where you think I'm wrong because to kind of TLDR this and summarize it, halvings are not the main impact of supply and demand anymore. It's capital inflows and hodler behavior.
Yeah, to be honest, I agree with pretty much everything you've said there. Definitely believe the 4-year traditional cycle that we've seen influence massively the halving event is probably past us. My only qualm, and this is an area which I would love to be proven wrong, I'd love to see a Bitcoin super cycle where we don't have these big drawdown percentages of 70, 80+% lasting a year to 18 months or so. I would love to see Bitcoin just have this very natural, healthy, sustainable step up in price action that we've seen so far this cycle. My only qualm is I think a lot of people kind of overemphasize and overestimate how smart the smart money is, how good the institutions are really timing the market. So this is maybe something where I can bring up some charts a little bit later to maybe outline my kind of thesis in this. But one thing that I'm kind of curious about is if you don't necessarily foresee Bitcoin having these big 75% bear markets, then do you maybe just see kind of this constant stepping up in price action, this super cycle that many people have talked about actually coming to fruition and lasting for the next 5+ years for Bitcoin? Or do you foresee if we do have a big drawdown recession, global bear market and equity markets, that Bitcoin maybe could still struggle and have these big bear markets?
Excuse me. I would actually say yes to both of those things. So one chart I'll share one chart, sorry, I'll share this really quickly. Is just ETF inflows over the last since they were created by quarter. So it's been positive every quarter. And so I think we have this new regime of passive inflows providing support to the downside. The equity markets have this. People would, they're not even thinking, they're just buying every time they get a paycheck, whatever. That's constant inflows. So I think Bitcoin's got that providing structural support to the downside. But I do think we continue to stair step higher as we have since the ETFs were created, and honestly, since the bottom of the 2022 bear market. Now, would Bitcoin likely go down significantly in a massive sell off in the equity market? Absolutely, it would. But I think we've kind of reached a point where Bitcoin may not be too big to fail, but it's very, very close. And I think realistically, the only scenario I could plausibly see Bitcoin having another 75% drop is if we get a similar sequence of events as we did in 2020, where there's just this insane amount of money printing in a very, very short period of time and everything balloons. We're talking Bitcoin going up 10x in 12 months because that's what it did from 2020 to 2021. It actually went up 20x. At the bottom of the COVID crash, it was $3,000. And then by spring of 2021, it was $60,000. And so I just don't think, given where Bitcoin's market cap is today, that Bitcoin does a 20x in 12 months. Maybe that makes me super bearish. Maybe, I'm the killjoy here, but I really don't think that's going to happen. Bitcoin already has a $2 trillion market cap. 20x from here, that's what, $40 trillion. I'm bullish on Bitcoin. I work in Bitcoin. I wrote a Bitcoin book. All my assets are in Bitcoin. I don't think that's going to happen. I would love to, it would be insane. But to me, that's the only realistic scenario where we get a massive bear market. And so the word super cycle kind of gets thrown around a lot. To me, I imagine a super cycle as being this almost Weimar Germany type moment where we actually really do have hyperinflation in the dollar. And, to be clear, I don't want that. I think that would be disastrous for our society. It would be disastrous for the world. There would be a lot of destruction and carnage because of that. But to me, I think of a super cycle as Bitcoin kind of, almost overnight goes to millions of dollars per coin and just continues to go up forever into, orders of magnitude higher than where it is today. So that's to me a super cycle. But if Bitcoin just kind of stair stepping higher, 25 to 50% CAGR with 30% bear market drawdowns, if that's the super cycle, then yeah, I think we're about to have a super cycle.
Exciting. One thing that I'm kind of considering as a potential catalyst for a more severe Bitcoin bear market, we'll say, is almost similar to the previous 2021, well, into 2022 bear cycle. Whereas previously we had companies like FTX and those over-leveraged stablecoin providers, etc., like Luna, 3AC, Celsius, everything. I could see this cycle something maybe coming to fruition as a result of collapses through Bitcoin treasury companies. Now, I know this is something that I definitely wouldn't like to see happen, But whereas MSTR strategy Sailor is almost like the Bitcoin of the treasury company market, the first mover advantage, and I would say has reached a point where I won't say too big to fail, but the probability of that happening is incredibly unlikely. Whereas as we get more and more treasury companies who are potentially just trying to make a quick buck, and especially as we get later into the cycle, if we do have a more explosive end to the year and we see other companies alongside GameStop dipping their toes, and especially companies that maybe don't have a sustainable underlying business model, seeing it as our get out jail free card and a get rich quick scheme, then maybe if we do start to see 30-40% drawdowns and we do see some liquidations in treasury companies and some forced selling in larger quantities, then that could maybe cascade. But I think, again, this is something that we'd see almost as a deleveraging event where we'd maybe see treasury companies who are just accumulating the Bitcoin of these treasury companies who have gone under. But I could see that as a potential outcome that would cause a more bearish bear market for Bitcoin. Do you see that as a possibility, or do you see treasury companies as a pure net positive in the space?
I see it as a possibility in theory. Right now, I don't see any treasury companies that are extremely leveraged with high interest rates and short duration loans, because that's what would happen, right? Is if a bunch of treasury companies leveraged against their Bitcoin on a 1 year time horizon, or maybe even a 2 year time horizon. Well, what we've seen a lot of them, one, there's not that much leverage in the Bitcoin treasury space, to be honest. It's a very, in my opinion, actually under leveraged space. I think these companies being with their access to public capital markets, I think some of them should take on even more leverage because they can get favorable terms where they don't have to pay their loan back for years on end. I think back to strategy before they even started the preferred equities, they were usually kind of spamming the convertible note playbook, so to speak, where they could borrow nearly 0% interest for long, long periods of time, 5 to 10 years. And then, of course, they have the equity convert option in there, giving the note holder or the lender some equity slash Bitcoin upside. But a lot of the treasury companies, they're not very leveraged. So if that happens, I want to be one of the first people to call it out. Like, hey, all these treasury companies have really poor loans, and if we get a drawdown, they could be forced to liquidate. But as it stands, I don't really see that in the current market. Could it happen? It sure could. But I think we need to be on alert and be ready to call it out if it does. But as far as I understand, the only treasury company that comes to mind with a loan that you might be able to classify as like sketchy would be Semler Scientific. I know they borrowed against, a small portion of their stack. I wouldn't say it's sketchy by any means. I think it gets 10% of their stack. They took like a $10 million loan or something because they have some DOJ lawsuit related to their healthcare business. But aside from that, none of these treasury companies, in my opinion, have really, poor loans that could result in massive liquidations. They've mostly been buying with equity issuances, pipes, and free cash flows.
Very valid points, fair enough. It's just one thing that I'm kind of considering and don't want to be an ultra bull. Like I see a lot of people in the space seeing it as a pure net positive. I think we need to be open to all potential outcomes. But one thing, as you kind of touched on many times, is this cycle has been more primarily driven by institutional investors, treasury companies, etc. And we've not really seen this big retail influx that we've traditionally seen throughout Bitcoin, where we get this big retail FOMO buying in at tops. But that does bring a lot of capital into the space and does provide Bitcoin with the rotation of capital to actually see these big percentage moves to the upside. Do you think that Bitcoin is maybe limited in its upside potential due to the fact we haven't seen this big retail influx? But does that also kind of limit the downside volatility that we'll see? I know we've touched on the volatility of Bitcoin diminishing over time, but do you think that the fact that we're not seeing this big retail interest in the market is a negative, or do you think Bitcoin can succeed even without the retail that we've historically seen?
I think it's already proven that it can, right? Retail has been basically absent for the last 3 years. They're not in the market at all, pretty much. And at this point, Bitcoin's a $2 trillion asset. Retail isn't moving the needle on that. Not, to the returns we want, right? I don't think retail is going to be getting Bitcoin from 2 trillion to 20 trillion. It's going to be the institutions. And we can kind of theorize on why retail is absent. I think they're just broke. Like in 2020 and 2021, everybody had a $1,200 fresh stimulus check. Money was loose. People had cash to throw around. Now it's pretty tight. And we can get into the macro stuff for sure. But one thing I see kind of anecdotally is just this diverging economy. You have people that save in assets and use AI and are really go-getters and ambitious, and they're doing well. They're doing really well. You can see the top 1% is continuing to get wealthier and wealthier. And then on the other end of the spectrum, you have people that don't save in assets. They just save in cash. They're living paycheck to paycheck, and inflation is really, really mounting. I know CPI says it's 3%, but if you price any good that people actually need, you know, gas, beef, housing, like all the important stuff, like life is just getting more and more expensive in dollar terms. And so the people that don't save in assets are just getting crushed. And so if they weren't saving in assets before, they definitely aren't now because they can barely afford rent and just paying their bills. And so I think we're going to continue to see the economy kind of diverge into the haves and the have-nots. And then maybe this is like incompassionate to say, but Bitcoin doesn't need retail anymore. The institutions are going to be what takes Bitcoin to the next level in terms of price. Now, we still want retail adoption for medium of exchange and people running nodes and mining and all this sorts of stuff. But from a pure price perspective, like retail is not moving the needle ever again in terms of Bitcoin price.
Yeah, something I fully agree with. I think we've surpassed that point where we need individuals to be putting in $100 into the market to see Bitcoin really thrive and survive like it historically had to do. We've crossed that boundary now, and the trillions of dollars of market cap that we're seeing and the hopefully continued $1 trillion of market cap increases we see are going to be due to the inflows we see from larger investors rather than those with, I'll say, thinner wallets. But one thing you touched on there was the influence of miners and how this potential reduction in retail involvement in the space, we'll say, potentially could result, well, it is resulting in less fees for miners in the space. And as we see less volatility in the market, potentially due to the dampening from institutional investors limiting the downside, but also potentially limiting the upside as well. Do you think that this could potentially lead to any centralization within the mining space because there's less opportunity at violent, volatile bear market lows and less incentive at bullish bull market highs? Do you think that this could lead to mining becoming a little bit more stable, I'll say? And is that good for the space? Would it lead to more centralization? Is it bad for the space, etc.? I'm curious, as a member of Blockware Solutions, on your thoughts on this.
Yeah, I'm not concerned about mining decentralization. I think you've got a couple dynamics going on. First, you mentioned like, hash price or mining revenue becoming more stable. I think that's absolutely happened. It's since the halving in 2024, hash price has basically more or less been around 5 cents per terahash per day. And so that's actually very encouraging to me to see because mining's kind of a leveraged play on Bitcoin, but with Bitcoin's volatility going down, mining revenues and trying to forecast what mining returns will be has become a lot easier, which makes my job easier because hash price has been so steady. So that's one thing. Two is the growth rate. I'll pause. Two is I think we're still in this gold rush because we have almost another 1 million Bitcoin to get mined between now and the 2036 halving. So I think for the next 10 years, mining is still going to be incredibly profitable. And on a dollar basis, 2025 is actually on pace to be the most revenue for Bitcoin miners ever, right? Even though we have these halvings and the block subsidies going down and transaction fees haven't really picked up to where we thought they might be, miners are still crushing in terms of dollars because Bitcoin's price has just done so well. And so I think if you're bullish on Bitcoin, you're going to be bullish on Bitcoin mining because I believe Bitcoin's price will more than double every 4 years. I think it's 2025 now. I think by 2029, Bitcoin's going to be over 240K or whatever double today's price is. So if you believe that's going to continue to happen, then mining, the revenue earned in dollar terms will outpace the halving and the drop in supply issuance. And so then it comes down to just staying competitive, getting access to low cost power rates and getting access to the most efficient hardware on the market, being able to continue to keep your profit margins high against rising difficulty by lowering your costs and acquiring more efficient machines. And one thing too is we talked about this pretty in depth last time I was on your show, but the slowdown in the growth rate of mining difficulty, Year to date, mining difficulty, I think, is up around 35%, something like that. Year over year, it's about 50 to 60%. But year over year, Bitcoin's price is up over 60, 70%. So Bitcoin's price outpacing difficulty on kind of shorter to medium term and long term time horizons, I think is going to continue to happen, especially as we see AI really accelerate. So AI presents kind of an alternative use case for stranded energy. So if you have low cost power and you're in the middle of nowhere, you're not near a major metropolitan area where you can sell that power to residential or commercial consumers, you have two options. You can mine Bitcoin or you can run AI high performance computing servers. And I think we're going to see more of these data centers shift. We've already seen this. I think this trend's going to accelerate, shift into the HPC business because that's more predictable cash flows. Mining is becoming more steady, but they want a cash cow where they can reliably generate revenue. They're not in the business of taking Bitcoin and that kind of exposure and that level of risk. And so I think we're going to see AI continue to take up more market share and more power share from data centers, which will just accelerate this trend of the growth rate in mining difficulty slowing down, which is actually really bullish for all of the people mining Bitcoin right now.
And we'll finish off, as you said, it's the start of Q4, historically the most bullish period for the Bitcoin price action. Do you have any expectations of how you foresee the remainder of 2025 playing out? As we're filming this, we can see Bitcoin's on a bit of a bullish run. Do you think that that's going to continue, especially post bullish Fed pivot and some more hopeful money printing? We're seeing injections into the system. Or do you think that maybe we're going to taper off? We're seeing the US dollar strength index maybe rallying a tad. How do you see the rest of the year playing out?
I am super bullish on Q4. I think, 4-year cycle stuff aside, I know it would time up with that, whatever. Bitcoin's got a lot of tailwinds in the market right now. The long-term holder sell-off that happened when Bitcoin hit $125,000, that's pretty much subsided. The Fed's starting to cut rates. That's super bullish. Gold has really taken off, which I think is a good forward-looking indicator for Bitcoin. We've got equity markets making all-time highs. Like, that's not things you see during a bear market. And so I think Bitcoin's going to do very, very well over the next 3 months. Is it going to 10x? Probably not. I think reasonably we could see Bitcoin between $130,000 and $150,000 by the end of the year. I think that's kind of the next range I have my eye on is around 140,000, where Bitcoin could continue its stairway to heaven with periods of consolidation. So short answer, yes, I'm super bullish.
Great. Well, I think that's pretty much everything I had intended to ask you today. And I think you gave some great insights there. So thank you very much for that. And hopefully people can go over and watch the second part of this collaborative effort on your channel as well.
Yes, thank you for having me, Matt. And like you said, part two, this is just part one. If you want to watch part two, which I'm going to be interviewing you, Matt, then you go to the description, go to Blockware's YouTube channel. You'll see it there. If you're watching this video, part two is already live on Blockware. So youtube.com/Blockware. And, everybody make sure to go watch part two on my channel.
Great. Thanks for that. I'll put the links to everything in the description. So check it out. And as always, thank you all very much for watching, and I'll see you in the next one.